Every economy depends on trust, but modern systems enforce trust after failure. Centuries ago, merchants traded across continents without banks, without insurance, and without guarantees, yet global commerce thrived. How was trust built before modern finance existed? Every economy, no matter how advanced, rests on a single invisible foundation: trust. Without trust, money loses meaning, contracts become useless, and markets collapse into chaos. Modern economies rely on courts, banks, insurance systems, and governments to enforce trust after things go wrong. But long before these institutions existed, merchants were already trading across continents, investing fortunes into journeys that could last months or even years. The question is simple, but profound. How did trade function in a world without instant communication, without modern enforcement, and without financial guarantees? How did strangers trust one another when failure, theft, or loss could mean ruin? History shows that trust was not accidental. It was deliberately built into economic systems through contracts, shared risk, ethical rules, and social accountability. Nowhere was this more clearly developed than in the commercial networks of the medieval Islamic world. Long-distance trade was dangerous. Caravans crossing deserts faced bandits, storms, and exhaustion. Ships sailing across the Indian Ocean or the Mediterranean could vanish without a trace. Merchants invested in voyages knowing that outcomes were uncertain and that losses were always possible. There were no banks to insure cargo, no governments to guarantee profits, and no instant way to verify information. A trader in Baghdad might invest in a shipment heading to East Africa or China and wait months or years to learn whether the venture had succeeded or failed. In such an environment, economic systems based on guaranteed returns would have been unsustainable. Fixed interest lending would have shifted all risk onto the borrower, encouraging reckless behavior by lenders and pushing traders into inevitable collapse. A different approach was required, one that accepted uncertainty instead of pretending it did not exist. Islamic commerce relied heavily on written contracts. Agreements were carefully recorded, witnessed, and legally recognized. These contracts defined responsibilities, investment terms, profit-sharing arrangements, and dispute resolution mechanisms in advance. Transparency was not optional, it was essential. By clearly outlining expectations, contracts reduced ambiguity and minimized conflict. When disputes arose, written agreements provided clarity rather than chaos. This system did not eliminate risk, but it made risk understandable and manageable. Trust, in this context, was not blind faith. It was structured confidence. Merchants trusted the system because the rules were known, consistent, and enforceable within the society they operated in. Instead of interest-based lending, trade was driven by partnership models that distributed both profit and loss. One party might provide capital, while another contributed expertise, labor, or management. If the venture succeeded, profits were shared according to pre-agreed terms. If it failed, losses were absorbed collectively rather than forced onto one side. This approach aligned incentives. Investors had reason to evaluate ventures carefully rather than seeking guaranteed returns. Entrepreneurs were motivated to act responsibly because success directly benefited them. Reckless speculation was discouraged because no one was insulated from consequences. Risk-sharing did not slow economic activity. On the contrary, it encouraged sustainable growth by tying financial success to real productivity rather than financial manipulation. In the absence of centralized enforcement, reputation became one of the most valuable assets a merchant could possess. A trader known for honesty and reliability could operate across cities and cultures with relative ease. A merchant known for deception quickly found doors closing. This form of social accountability was subtle but powerful. There were no public announcements or dramatic punishments. Trust simply withdrew. Over time, reputational networks created self-regulating markets where ethical behavior was rewarded and dishonesty was quietly excluded. Reputation functioned as a form of economic capital, earned through consistency and lost through misconduct. In many cases, it mattered more than wealth. Markets were not left entirely to chance. Oversight ensured that basic ethical standards were maintained. Weights and measures were checked, fraudulent practices discouraged, and artificial price manipulation addressed. These regulations did not eliminate competition, but ensured fairness and predictability. Importantly, ethical rules applied to everyone. Merchants could not exploit ignorance, manipulate uncertainty, or hoard essential goods without consequence. This created stable commercial environments where long-term trade relationships could flourish. Predictability, rather than perfection, became the goal. And predictability is what allows economies to endure. These systems were not confined to a single group. Muslim, Christian, Jewish, and other merchants participated in the same markets under shared rules. Trust was institutional rather than personal, allowing commerce to cross religious and cultural boundaries. This inclusivity strengthened trade networks and expanded economic reach. By applying consistent rules to all participants, markets became spaces of cooperation rather than conflict. Trade thrived not because differences disappeared, but because systems accommodated them. Economic systems endure when they acknowledge reality. The medieval Islamic commercial model accepted uncertainty, shared risk, and prioritized ethical constraints. Growth was gradual, setbacks were survivable, and collapse was rare. Unlike systems that concentrate risk and amplify failure, this approach distributed responsibility and limited systemic shock. When disruptions occurred, they were absorbed rather than magnified. This is why these trade networks survived for centuries and influenced economic practices far beyond their original regions. Trust cannot be imposed after failure. It must be designed before trade begins. History shows that when ethics, accountability, and shared risk are embedded into economic systems, markets do more than grow. They endure. If you value thoughtful history that explains how trade and trust shaped civilizations, consider liking this video and subscribing to History Showcase. History does not end. It waits to be understood.